You know when someone invents a tiny trick and the whole country ends up using it? That's Mkopa. It's the company that turned pay small, get big into a money machine. Phones, solar kits, now even electric bikes. From a Nairobi idea to millions of customers across Africa, the glow up is real. But of course, where there's big money, there's big tea. Stick with me. 3 people in Nairobi, Jesse Moore, Nick Hughes, and Chad Larson, and remember that name because I'm telling you there's some Zungu boardroom drama happening. These 3 looked at a simple fact. The everyday earner doesn't live in monthly salary mode. They earn every day. So why make them pay in lump sums? The idea was almost obvious. Synchronize payments with how people actually earn. Tiny payments, big impact. Think of it like a daily SIM plan for appliances. Pay a little, the device works. Miss a payment, it politely goes to sleep. Harsh? Maybe. Practical? Definitely. The first product wasn't a shiny smartphone. It was a solar home kit. Panel, battery, a few LED lights, and USB charging. For families using kerosene lamps or walking to charge phones at a kiosk, it was revolutionary. Kids could study after dark, shops could stay open late. That picture is everything. Light plus phone equals options. That kit proved the model. People would pay small amounts to get a big change. Mkopa stitched 3 things: cheap solar tech, mobile money, M-Pesa, and human behavior that loves small manageable payments. Here's the flow. You pay a small deposit, you get the kit or phone, then you top up weekly or daily via mobile money. The device has a tiny controller that reports payments. If you pay, it stays on. If you don't, it can lock remotely. This is why some people call it brilliant and some people call it mean. It depends how many times you forgot your M-Pesa pin. Lights were the open door. Once a family trusted the payment relationship and had a connected device at home, Mkopa could offer more. Smartphones, digital loans, insurance, health cover, and even e-bike financing. Slap a smartphone in somebody's pocket and suddenly they're part of the digital economy. Loans, savings, mobile data, apps, that ladder is the real trick. Start with a need, then climb into higher margin financial services. Mkopa is not a small NGO project anymore. It's an industrial fintech. By the mid-2020s, they reported millions of customers across multiple African markets and hundreds of millions in revenue. They've raised large rounds and deadlines to fund the inventory and billions of shillings in customer credits. That cash allowed them to scale across Kenya, Uganda, Nigeria, Ghana, and now South Africa. One of the big moves was not just selling phones, it was assembling them locally. Mkopa partnered to set up Kenya's smartphone assembly lines, producing hundreds of thousands to over 1 million devices annually. That matters for margins, jobs, and supply chain resilience. Suddenly, it wasn't just we import phones, it was we build them here, we hire, we certify. That's a real industrial story. Now let's talk about the mobility. The e-bikes for boda drivers and couriers. Partnerships with ride platforms like Bolt have pushed thousands of e-bikes on the road. The model Mkopa pioneered is what we call pay as you go. It's a system that allows customers to access products immediately and pay in small daily or weekly installments. Think of it as the African version of buy now, pay later. The same idea that companies like Klarna or Affirm built billion-dollar businesses around. Except here, it's not for online shopping, it's for life-changing essentials. Solar energy, smartphones, and even electric motorbikes. So while in Europe someone might finance a handbag, in Uganda or Kenya, someone is paying for the light that powers their home or the phone that powers their livelihood. So now that we have understood the buy now, pay later model, let's go back to the mobility. You remember the e-bikes. For a boda driver, switching to electric is not just green. It can be cheaper to run and faster to service, improving earnings over time. That's the same daily payment logic but with wheels. Pay a little, get a big shift in your life. Scaling like this is expensive. You need inventory, factories, agent networks, repair centers, and you underwrite customer credit. Mkopa raised large sums, both equity and debt, from big institutional investors to fund growth. That helped them expand fast, but it also created classic asset finance pressures, big upfront capital, and the need for patient unit economics. In some years, that looks like losses while you build scale. In others, profit starts to show when the engine clicks. The impact stories are everywhere. Girls studying under LED lights, market vendors staying open late, drivers saving on petrol, The company publishes impact numbers, but the real receipts are the faces. A woman charging phones as a small business, or a student finishing homework. That's the human benefit and the heart of the narrative. So recently, there's been a lot of buzz around Mkopa, especially regarding how they're handling shares for their Kenyan employees. Now, remember Chad's name? Chad Larson, who's a co-founder and a major shareholder of Mkopa, he actually sent a formal complaint because he's really concerned about the way the company is buying back shares from Kenyan employees. These are people who've earned their shares either through years of service or through fully vested options. They basically worked for them. The company, along with a big shareholder called Sumitomo Corporation and an advisory firm called Eden Global Partners, is buying back these shares at a price that seems way too low, like around a 95% discount from what the shares are actually worth. Basically, the employees are getting a tiny fraction of what their shares should actually be worth. Meanwhile, Sumitomo benefits first, and Eden Global Partners gets a huge fee from facilitating this deal. Now, there are several major problems here. First, conflict of interest. The same people approving this buyback are the ones who profit from it. That's a big no in corporate governance. Second, manipulation valuation. The share price seems deliberately low to favor big shareholders and disadvantage the employees. Then, there's also exploitation of local shareholders. Kenyan employees are being offered unfair prices, which is like taking advantage of their lack of insider information. Then again, the corporate governance breach. The board is supposed to act in the best interest of all shareholders, but this doesn't seem fair or transparent. There are more issues too. Employees aren't allowed to talk to each other about the sale, which isolates them and stops them from asking questions or seeking advice. And smaller shareholders, the ones holding less than 500 shares, they're being denied basic rights like attending meetings or seeing minutes, while larger shareholders get full privileges. So collectively, this isn't just about one unfair buyback. It's a pattern of treating Kenyan minority shareholders unfairly, raising serious questions about whether Mkopa is following Kenya's corporate governance rules.